Okay, well, welcome to this webinar looking at valuation perspectives on the treatment of operating leases as part of the IVSC's Valuation Webinar Series 2021, sponsored by Duff & Phelps, a Kroll business. Shortly, I will hand over to our moderator for today's webinar, but before we get started, just a quick reminder that this is part of a 5-webinar series being hosted by the IVSC and Duff & Phelps in May, and you can register to join the final 2 webinars in this series, which will take place next week. One is looking at valuation and ESG, and the other is looking at the impact of eyeball reform on valuation. And you can register for those by visiting the IVSC website at www.ivsc.org. During today's webinar, you will be able to post questions to the panel using the Q&A button on your screen. And we will also have polling questions throughout to capture your views on certain topics. If you hold a qualification with a US-based professional institution, then you can also claim CPE credits for your attendance on this webinar today. To qualify, you will need to provide answers to the polling questions and stay with us for the duration of this webinar. You'll also be able to claim the CPE credits by checking the relevant survey box at the end of today's webinar. Finally, the views and opinions shared by our panelists are for the purposes of this discussion and do not necessarily reflect the positions of their organizations, the IVSC or Duff & Phelps. Our moderator for today is Carla Nunez. Carla is a managing director in the Office of Professional Practice at Duff & Phelps, a Kroll business based in Philadelphia. In her OPP role, she provides firm-wide technical guidance on a variety of valuation, financial reporting and tax issues. She's also the global leader of Duff & Phelps's Valuation Digital Solutions Group, which produces the cost of capital thought leadership content. In 2011, Carla completed a 1-year rotation in Duff & Phelps' London office, where she promoted the firm's IFRS education efforts and marketing initiatives and dealt with IFRS implementation issues. So with that, Carla, over to you.
Thanks, Richard. And thanks everyone who is joining us today from across the globe. We have a an excellent panel of people who've been involved with operating leases, and we hope that this is a useful webinar for you to take away in your practices. So as Richard mentioned, I do in my OPP role deal with global teams across the globe on a variety of issues, financial reporting, valuation, tax, and operating leases is one of those topics that have been on the radar for the last couple of years. And in that respect, we actually at Duff & Phelps, I've been involved with us developing best practices for how to treat operating leases and valuations, and particularly in the market approach model. And so I come from this in this discussion from a valuation standpoint. We're very fortunate to have different perspectives in this panel. And so what I'm going to do is I'm going to ask each of our panelists to introduce themselves and talk about their experience with operating leases, and then we'll get started. So why don't you start with Steve?
Okay, thanks, Carla, and thanks for inviting me today. So hello, everybody. I'm Steve Cooper. I was a board member at the International Accounting Standards Board from 2007 to 2017. And I guess this period pretty much covered the whole of the development of IFRS 16, from the first discussion paper through the 2 exposure drafts, through working with FASB to try and achieve a common standard, which of course ultimately failed, and then right through to the final standard. Prior to joining the ISB, I mostly worked in investment banking. That included equity research, corporate finance, education and training, and of course leasing was an important element in much of equity research. Before that, I was an accountant. Since retiring as a board member, I've still been involved in standard setting. I carried on working for the ISB for a while as a consultant, although that was mainly focused on insurance accounting. And I've done other sort of training and consulting engagements since, and leasing has often come up. That's been mainly for investment banks and analysts. I mean, leasing is a very interesting topic, and I've always been particularly interested in the interaction of financial reporting with equity valuation. So I've been very interested in how the leasing issue has developed. I now spend my time also writing a blog called The Footnotes Analyst, and that includes several articles on some of the topics that we're discussing today. Carly, you're on mute.
Thank you so much, Steve. So why don't we go now to Brian to give his intro.
Well, thank you, Carla, and hello, everyone. I'm Brian O'Donovan. I'm a partner at KPMG. In particular, I work on our global IFRS desk. So I'm physically based in London. I have a global role, and I sign out all of our global guidance, all of our global publications, all of our global training on application of IFRS 16. I actually moved into my global role in 2006, just before Steve joined the board, because I heard that the ISB was going to do something with leasing, and I thought it would take about a year, and I wanted to be there when this very short project was finished. In addition to working for KPMG, I'm a member of the IFRS Interpretations Committee, the IFRIC. That's the body that tries to work out what the standards that Steve produced actually mean. And since IFRS 16 has come out, I've spent quite a lot of time with the committee on questions like, how do you determine the lease term? What kind of adjustments do you make to come up with a discount rate? And all of that material is published in the IFRIC update. I mean, on a personal note, this time of year, I think of this as conference season, and this time of year, I'm usually flying around the world in leased aircraft and staying in leased hotels and giving in-person presentations in leased conference facilities, and I kind of miss that. But I also think that it's great to do this kind of thing virtually, because we can gather this great panel together and a really distinguished list of attendees as well. So I'm very happy to be here today.
Excellent. Why don't we go now to CK? Why don't you tell us about yourself?
Okay, thank you, Carla. I'm CK Lau. I'm Managing Director of Colliers, responsible for the valuation and advisory services in Asia. That would include China, Hong Kong, and Singapore as the key markets. I'm based in Hong Kong, and I'm also a member of the Tangible Assets Board of the IVSC. I've been in the property industry for over 30 years, with some 25 years, in the provision of the property valuation services. The services would include financial reporting, and that would include, capital valuation of properties, including leasehold interests, and that would, require a lot of interpretation of the operating leases. And of course, we also provide, rental valuation service for bank review purpose. I cover many types of, real estate, including office, retail, industrial, and logistic properties. Thank you.
All right, and last but not least, Sandy.
Great, thanks. So I'm Sandy Peters. I work for CFA Institute in their advocacy arm, not the educational arm. So I have spent the last 10 years explaining to the IASB, including writing comment letters to Stephen and being part of conversations with the IASB and Stephen about why investors wanted leases capitalized. In fact, I think in one of our comment letters, we actually found, when we were archiving our comment letter on leases from 1971, where we said leases should be on the balance sheet. So we're very consistent in our views. It just takes a long time to get what we want. So I actually, like I said, wrote several comment letters related to the exposure drafts and the conceptual or concept papers for US Gaap and IFRS. And in 2019, I wrote a paper on investor perspectives on the new leasing standards and the top 10 considerations for investors. And I think as I went through this, I think it's more applicable than maybe ever. So I also was engaged in the US in visiting Congressman Shelby when he was advocating for leases not being on the balance sheet, showing that in fact CFA Institute has put them on the balance sheet as a part of the program for decades. So I've been very involved in the last 10 years in moving for what investors want on the leasing standard. In my prior life, I was a partner at KPMG for almost 20 years, and I was corporate controller at MetLife, where I had responsibility for corporate real estate, including all of the leases. So my experience runs the gamut, but most recently what investors want as it relates to leases, and I hope to share that today.
Excellent. So as you can see, we have a very distinguished group of panelists, and we'll have different perspectives, both from a valuation, an accounting, and an investment/analyst. So like when you look at earnings estimates, what do they include? Things like that. So with that, we want to know a little bit about yourself. So we're going to start with 2 polling questions, and they're going to be we're going to tell you just while I'm showing on the screen which geographic region you're located. If you could click on that. And from a housekeeping standpoint, we have 7 questions today, but if you answer 6, you'll still be entitled to get credit. So just, if you miss one by any chance, don't get upset. You can still get credit. So in which geographic region are you located? So go ahead and we can get the results. Wow, it's actually pretty broad. So we have 30% from Asia, close to 30% in Europe, and 25% in North America. So this is actually a quite broad audience. So thank you so much for joining us. The second polling question will come right now as well, which is we want to learn what is the primary asset class in which you focus your valuations, or that you perform, or that you review. So is that business and intangible valuations, alternative asset investments, real estate, machinery and equipment, or other not applicable? If you could go and let us know about that, that would be wonderful. And let's see the results. Okay, so we have the majority, so over half, it's in business and intangible valuations, followed by a third in real estate. So I think we have what we're going to discuss today will appeal to this audience. So with that, we're going to get started. And I'm going to very briefly provide, just so we're all on the same page, about the major differences between IFRS 16 and Topic 842 under US Gaap for operating leases, just so we're all talking the same language. So I'm just going to share 2 slides, and that's the only slides we'll share this session. And it really just to give you a broad overview of that. And if Richard at the IVSC enables me to share the slide, that would be fantastic. Oh, there we go. Perfect. So here we focus first on the balance sheet. And again, by the way, most of our conversation tends to be focused on lessees. The reason being because the new standards, when they came into, when they were effective, they really didn't impact too much what lessors were already doing. So a lot of times today, we'll be talking about these issues from a lessee perspective. So let's just very briefly see what changed and what is different versus similar between IFRS 16 and Topic 842 and the US Gaap, which, as Steve mentioned in his intro, was initially a joint project that was supposed to be converged, but we ended up here where not everything is converged. So the one thing that the CFA Institute wanted did get accomplished, which is operating lease liabilities are now on the balance sheet. So they recognized as a claim to the cash flows. And broadly speaking, the valuation of the lease liability is similar because what we're doing is just doing the present value of the remaining lease payments that you have in the term of the lease. And of course, accountants will get very involved in determining what is part of the lease, and is this a, what is the term, and when do you incorporate options to renew, and all these things. But once you have that, from a valuation standpoint, the exercise is fairly straightforward. And the one question that actually tends to arise is, how do you compute the discount rate, which often in the case of lessees tends to be this concept called the incremental borrowing rate. So that's on the lease liability. Let's look now at the asset side of things. And that's, there's this new asset, because obviously your balance sheet needs to balance, right? And so you have this right of use asset that gets created. And here, we don't have exactly the same treatment unless there's an impairment in the case of US GAAP. But if you don't have that, the right of use asset in IFRS tends to be, it's measured somewhat like you would do normal PP&E, property, plant, and equipment, or fixed assets. Whereas in US GAAP, you would do it based on such that the depreciation, well, not the depreciation. By the way, when you look at at actual US GAAP financial statements, they'll typically call it amortization of right of use asset instead of depreciation. Do not to be confused, but that's what they mean. So you tend to have a straight line lease expense, amortization of leases going through the balance sheet. So you might have a different, or you will have different after inception. You'll have a different amount should you have exactly the same lease, but under IFRS versus US GAAP. Now, where analysts and valuation professionals have struggled even more is the next slide. Which is, the income statement, or as some people call it, profit and loss statement, or P&L. And here's where the challenges are really more acute in terms of valuation. So IFRS, first of all leases now are called finance leases. And so if you remember, before it was operating leases and capital leases, now everything is called finance leases. And for today's purpose, and I often do this when I'm, talking internally at Duff & Phelps, etc., I tend to still call operating leases versus finance leases, just because I want to compare US GAAP with IFRS. But so everything is a finance leases for IFRS 16. So what does that mean? Before, we're used to have a rent expense, you now can have like three components. You have like depreciation expense, you have the interest related to the lease liability, an interest expense, and then you could potentially have a variable rent. What is that variable rent? Not to get too complicated, but it is important to understand industry differences, which is like if you have certain types of leases that are not fixed payments, that are dependent on, say, for example, think about an airline, where the lease for, renting the gate at an airport is dependent on how much traffic the airline runs through that gate. Because it's variable based on the performance or the usage, some of those leases would not qualify to be capitalized on the balance sheet. So it would continue to be the old way, if you will. So you'd continue to have a variable rent expense related to those leases, even in IFRS. They tend to be small in most industries, but airlines is actually an exception, as an example. So if we ignore variable rent and we just think about the old rent expense, you now have that rent expense, bifurcated between depreciation and interest expense, meaning that from a computation of metrics such as EBITDA and EBIT, they're no longer the same as they were before. Right. Now let's flip back to US GAAP. So US GAAP also has finance leases, which is the old capital leases, and that treatment is similar to what it was. But the operating leases, that's where the discrepancy really arose, which is you continue to have a rent expense, like the lease payment. You might still see, US GAAP filings might still call it rent. Some might call it just lease expense, but what filers are doing is they're just doing what they were doing before. You have a single line item in your income statement. And the problem is, if you are computing metrics like multiples, for example, trading multiples, and you have a group of companies that you were looking at, and the listed companies or publicly traded, whatever the term you use, are are US GAAP versus IFRS, you're going to have a discrepancy on those metrics, and they're not comparable unless you make certain adjustments. And that's some of the things we'll talk about today. So with that, I just wanted to give this intro so we're all on the same page on like some of those differences. And so we're going to start with, our first question, right? Or like for our panelists to discuss. So because of these differences between US GAAP and IFRS, what have you learned from your perspective in terms of how, for example, analysts are dealing with these differences in their research reports? Do investors care? Like, are they making these distinctions? If you know anything about, data providers like GaapIQ, and I can always give a little bit of light on that, on what GaapIQ and others are doing. And is that different for the perspective, like for valuation professionals? Do valuation professionals have fully embraced the new operating leases? What are they doing versus what are analysts or investors considering? So I'm going to start with Steve to give us his perspective and what he has seen in practice.
Okay, thanks, Carla. So I can talk mainly from an analyst and investor perspective, perhaps a bit less so from a sort of valuation professional perspective. So in my experience, investors and analysts are pretty well aware of the change. It's been around for a while now, and I think they've seen it in financial statements, and most of them have taken some steps at least to engage with it and to understand. Particularly, obviously, those sectors that have been heavily impacted by the change. I think most seem to pretty well understand it, at least at a high level. Maybe they don't get into all of the detail. I think most are very focused on it, and they're aware of the challenges. I think the discrepancies, Carla, you mentioned, I think they're aware of that and aware of the gap difference. In terms of how analysts are dealing with it, I think there's quite a lot of variation. I think it varies between US-focused analysts and those covering IFRS. I also think it varies by industry. So I think for US GAAP reporters, well, as you pointed out, not a great deal has changed. Obviously, we've got the liability on the balance sheet and the asset, but in terms of the income statement, which is clearly the key focus, not a great deal has been affected. So I think there's a great tendency for the US analysts to stick with what they have been using previously. Now, I know that Sandy pointed out that the CFA Institute has long recommended putting leases on the balance sheet and including leases as liabilities in people's analysis. And I'm sure many of their students have taken that on board. But at least in my experience, most US analysts don't do that unless it's for a sector that is particularly impacted. So why do anything different now, I think is the question. I think if US analysts have been capitalizing leases in the past, they of course now are in a better position because they have some extra data to work with and to make those adjustments on a more realistic basis. For those analysts following IFRS companies, I think it's much more mixed. They're obviously faced with a much bigger change, as you pointed out in that slide. The figures in profit and loss can have changed materially. So they've got a decision to make. Are they going to embrace the new standard and the new data, or are they going to revert back to the old approach? I think for a lot of them, the key question was the effort of adjusting models, particularly DCF models. We'll come on to that later, I think. And the idea of having to adjust models was a major factor in dissuading some of them to switch. I think the fact that some companies carried on providing pre-IFRS 16 metrics, that also persuaded some not to switch. There was also the problem of having to adjust historical data. You know, if you're a quant analyst and you've got decades of data, you know, why would you then want to throw all that away or have the bother of adjusting? So I've seen both views applied. Some have embraced the new data, some haven't. Personally, I think they should embrace the new data because I think it's better and more useful. But as I say, I think the reaction has been mixed. I know data providers have been doing some work on it, and you'll probably be in a better position to comment on that, and also from the point of view of those working in valuations.
That's great to see like a little bit of the landscape and what's happening right now and the challenges that are created. So, Sandy, do you want to give your perspective next?
Many of my comments would be the same. I think that people are. I reached out to my advisory committee to see sort of how their different organizations are dealing with it. I got different answers. As Stephen said, I think that there is still an effort to sort of figure out what is, you know, what's transpired and what needs to be adjusted to be comparable with the past versus what's in the forward-looking estimates. I think that interestingly, we had talked about data providers like Capital IQ, and they said one thing and then they changed it, and then are they really adjusting it? And actually, one of the people without my coaxing them brought that issue up and said that it seems like forward, most people are getting it right, but going back, not so much. And I think that I reached out to someone who's mostly in an IFRS jurisdiction, and he said they're making adjustments for it. Not everyone is, not everyone's being consistent. I think that through that process, I learned that, you know, I think there is, what the data providers like Capital IQ did was say, we're going to exclude the depreciation on the right of use asset, but I don't think it was clear what excluded meant, when it is actually a deduction, an add back of an item that's deducted. So excluding it means from which part, right? I think is what became the question. And I read the stuff and I'm like, I got to see an example, right? So I think what they actually did was say for IFRS, we're going to just ignore the depreciation and not add it back. So make it more comparable with what was the EBITDA for US GAAP, because in theory, EBITDA for US GAAP didn't change, and EBITDA for IFRS became EBITDAR. So to have them be pari passu, you have to add back the rent expense for US GAAP, and they sort of forgot about the denominator, the enterprise value, and saying, oh, that now includes for both US GAAP and IFRS, the liability. So how do you make them comparable? So then they said, okay, well, we're going to add back the rent expense and we're going to add back the depreciation so that the enterprise value and EBITDA are consistent. So I think all of that machinations was confusing to people. And I think people are working that out. The one comment I got back is that things like EV divided by EBITDA as a heuristic will change, and that you have to pay attention. We could talk about that a little bit more to the lease term. So I think that right now I got the sense that people are really trying to figure out how they adjust, how they compare back, how they compare forward, and how they decide how they're going to deal with this in perpetuity, and what adjustments they're going to make, and what it actually means to them. I think they're in the learning phase of the process. There's actually an academic study I'll talk about in a minute, but I think that people are really just sort of sorting it out and figuring out, as Stephen said, how they want to treat it and how they want to think about it for their own mindset.
Thanks, Sandy. And I might provide a little commentary on the Capital IQ as well. And just because some of these people are doing, half of this population is doing intangible and business valuations. But I'm going to ask first if either Brian or CK want to comment on this, and then I might just provide my perspective from valuation, what I see with our project teams around the globe.
Yeah, well, Carla, if I go first, I mean, I'd agree with everything that Steve and Sandy said. I think we have to remember that we've only really had 2 reporting seasons under these new standards. Both of those reporting seasons have been dominated by incredibly volatile kind of market conditions. I think both Steve and Sandy talked about the change. Has practice really settled down? And I feel that practice has not settled down. I think the companies themselves needed to explain the change. They wanted to present trend data, and that's one of the reasons why Steve and others have seen old accounting data being reproduced and carried forward. I can't imagine that the companies themselves in their financial statements are going to continue doing that indefinitely, particularly not under IFRS. They will not want the cost of that kind of dual running. So I see a lot of diversity at the moment in reported KPIs within the financial statements and the way that valuers use them. I wonder if that's partly a condition of where we are right now in this change process. Maybe things will bed down, hopefully against smoother market conditions over the next few years.
Actually, can I jump in with a comment, Carla? Because one thing I forgot to say is
Sure.
that you had asked what, are people focusing on it? And I think the answer depends on the size of the adjustment, right? I actually, for fun, went to CalBench and said, help. I couldn't get the FactSet data because the person who is on that team was busy. So I just got the US data, and it's the increase in the right of use asset and the lease liability is about 1.2 trillion out of about 97 trillion in assets. So I think at one point, the IFRS Foundation said they thought it would be about $3 trillion, but that's globally, just to size the adjustment, at least in the US market. That's about how big it is, but it is concentrated. As we, in the paper we wrote, we said it would be in 3 industries, basically retail, airlines, and telecommunications. And I think you actually see that, though in the US, one of the biggest adjustments is on Amazon to the balance sheet. So it's interesting to sort of parse it down and look at it, the size of the impact by sector. And I think where it matters, it really matters, and people pay attention to it, to Stephen's point. And where it doesn't matter, maybe people should pay attention to it a little bit more because of the fact that it could be impacting comparability of things that they don't necessarily see quite yet. So.
And that's an excellent point because, so for example, I had looked internally, just to give an example, on how over time things have changed and how they affect multiples. And I looked at Microsoft, just because, they were early adopters. So when I was looking at that, I had a little bit more data to compare. And so a couple of things that I saw. One is they put, about $5 billion of leases on their balance sheet, which when I look at it, wow, $5 billion is a lot, but in the context of the total assets for Microsoft, not that much. But I did see a couple of things, which is, one is previously they barely had any capital leases on their balance sheet, and then suddenly it exploded in a sense that now maybe you'd have like 1 to 2 billion in new finance leases and then the rest in operating leases. So whatever the standard did, and I know Brian, would be so familiar with this, but it made more leases. It's not just you have more leases in the balance sheet, but also it changed the ratio in US GAAP, at least like what is finance and what is operating. And then the other thing is like, does it impact the multiple? Like when you're computing, for example, like you said, an enterprise value to EBITDA multiple, and It did impact, in some cases, about half a turn, 0.5, which some people, when they're looking at just, broad valuations and fairness opinions and things like that, might think that 0.5 is not a lot. But some other people, when they're concluding on a point estimate of value, they actually think that that's material. So the point being that some people are focusing more on it than others. And I agree as well from a valuation standpoint that to the extent that the leases are not a big component of total assets, at least in the US, it's essentially being ignored. What does that mean? You continue the old way with the rent and how you computed EBITDA before, but you are removing the operating lease liability from the total debt account. And that matters for people who also are doing things like Capital IQ, where you buy just off the shelf. Let me do a quick and dirty. Let me see what the Capital IQ multiples show. And then you might be surprised, because the way that Capital IQ is currently doing it is they decided to, what you alluded to, Sandy, to correct that inconsistency. So they now add all leases to enterprise value, into total debt. And so that impacts ratios, for example, financial ratios. And then, but on the other hand, they add back this rent expense in US GAAP, and they call it a lease adjusted EBITDA. And for IFRS, they really don't have to do much effort, because companies are already reporting what the depreciation is related to leases. So that's a very, very easy adjustment to be made. So the challenge is in the on the US GAAP side of things. But I see people in the US just reversing out those adjustments and just do the old way. Whereas in IFRS world, and our colleagues in outside the US are actually embracing the new, because it's just easier. That's what's reported, that's what's coming through automatically through these providers like Capital IQ, for example. So it just becomes easier, in other words, to just follow the new rules. So that was one comment.
Yeah, I think what that tells us is that people, investors and analysts will adapt, right? And we want them to adapt to what we perceive as better information. That's why we weren't satisfied with what happened in the US. But I would also say that when I prepared the paper, where I actually go through every ratio we put in the CFA program and talk about what the impact of the leasing standard will be for both US GAAP and IFRS, and then I looked at some examples of companies that had early adopted. And I think companies are trying to figure out actually what it means, right? I can recall during the discussion and debate about the leasing standard, a big company controller saying, we're going to find all these leases and we got to figure out this is going to be so hard. And I'm like, I think you're making our case is to the fact that we believe these are liabilities, and you're telling us you can't even identify all of them. So the footnote is really not very good, right? But we want to see that. But I think the point that was made earlier, that this has been, a lot of other things have happened in the year where basically it was supposed to settle down on leases. We had other things to deal with. I still think companies are really trying to figure out how they explain it and what that looks like to the ratios and KPIs that they talk about.
And I think this is very interesting and lends itself to the next discussion point, is what differences are we seeing between industries? And I'm actually going to start with CK, just to see from his real estate perspective, and I know that CK is a bit more focused on the lessor side of things, but what has he been seeing, and in Asia, et cetera, and then we can go around and ask what other things you'd like to comment in terms of industry. So CK, do you want to get started on that?
Thank you, Carla. As you said, we mainly, for property valuation, we mainly, focusing on the rental, on the land lessor side. But right now, we are yet to see how major occupier of space will react, to this change, in the Asia region, how they would so-called structure their requirements in the instructions to property valuers, for example. And whereas, for the changes, whether there will be a change in the sort of leasing practice, that could be, happening, but we are yet to see whether people would change to shorter leases in the future, so that, I mean, the impact onto their balance sheet or their accounts, I mean, would be less impact by long leases. So these are trends that we are yet to monitor what will happen, what will be happening then. Yeah, thank you.
Okay, thank you. So, Steve, do you want to see any comments you would have, like in terms of, following analysts, and do you have any comments in terms of diversity in industries, or even within the same industry? Like, do you see any trends of like in terms of those practices?
Yeah, I think it tends to follow what people were doing before. I mean, there are certain industries, and airlines that Sandy mentioned is the key one perhaps. Certain industries where analysts traditionally have been making adjustments, not necessarily as their only method of analysis, but certainly at least as supplementary to their analysts. And if they're already doing those adjustments, well, the new approach just helps them to get to a better answer, particularly IFRS 16, but you can also get there better with the US GAAP disclosures as well. But there are other sectors, and retail perhaps is the key one, where I think analysts have been more resistant to it, at least the ones that I've talked to. I think many of them have regarded the change as an unnecessary complication. Some retail analysts have said to me, look, it's a simple business. Our expenses are our rent, our salaries, purchases, and we just got to make sure that we generate a revenue that covers that rent. And converting the rent into interest and depreciation, I think some of them have thought is just confusing. And I think quite a lot of the retailers themselves that they talk to have been very anti the change, and certainly my experience at the IASB, the resistance very much came from the retail sector. But it's not a view I subscribe to. I would certainly advise retail analysts to work with the new data and to regard leases as financing, even as regards property leases. I think it provides them with additional insights. I think it can improve their analysis. But as I say, I think it does vary by sector.
Brian, do you want to give us your perspective?
Yeah, I mean, it's interesting because unlike some other bits of accounting, this accounting change is not itself industry specific. It gives you a model, or in US GAAP, 2 models for accounting for leases. And for me, that's the secret to it. That's the real benefit. So in the past, as Steve said, maybe an airline was giving you lots and lots of information about its aircraft leases. Maybe a retailer was kind of telling you about its property strategy, but not telling you very much about its actual lease commitments. And now, across the board, whatever the industry, they have to provide certain specified information in quite a defined format, and they have to get people like me, they have to get auditors to give some degree of assurance over that information. So the real benefit, I think, is in standardization. So if you're getting lots of information before, maybe the incremental benefit is modest, but you can rely on it in a way perhaps you couldn't before. In terms of retail, if you previously heard about the property strategy, you now have a lot more information. I think the requirement isn't really industry specific, but it affects different industries in different ways depending on how they contract for their leases. So you were saying as part of your introduction that if you're an airline, maybe you have variable rent expense for the gate. You maybe have fixed rent expense for the planes, variable expense for the gate. If you're a retailer, maybe some of your rentals are fixed, maybe some of them are variable because they depend on turnover, and all of that is the kind of thing that I think people need to really engage with. I was really interested in CK's comment about, would the new standard lead to shorter leases? Would it lead to more variable rent? Would people change their leases to reduce their reported lease liabilities? In fact, what's happening is people are doing all of those things but for different business reasons. They're doing it because it's been an awful year for bricks and mortar retail, and everyone's having to renegotiate their leases. So from my perspective, This is not an industry standard. It's about standardization, but it flushes out different kinds of commercial practices, different kinds of leasing agreements that you just wouldn't have had the same visibility of previously.
And that's an excellent point. And just picking up on what you said and Steve said as well, which is just even though it's not the focus today, but just to see how, for example, rating agencies approach the issue. And it used to be that Standard & Poor's was already doing a present value of lease obligations before the adoption of new standards. So for them, this was like very small change to their methodology because they always believed that you should include operating leases as debt. Now you turn back to Moody's, and Moody's used to do multiples of rent. And what I've seen in practice in the US is that a lot of people who are just reversing out what happened with US Gaap with the new lease standards, they might actually continue back to the retail comments. Oh, I'm going to continue to do a multiple rent just for the one industry that I care about, which is retail, and I continue to do that, even though Moody's said we don't see a need to do that anymore. Now that the companies are reporting this new information, we're just going to start using that information rather than this. It was very prescriptive. It at first started with like 8 times rent. And now it evolves to say, well, these types of industries is 5 and these types of 8, but it was not really reflecting the actual liability that the company had. So it was very generic. And then curiously enough, in Cap Like You, by the way, when they want to do the historical comparison and they compute like what was the implied interest expense, they just do 8 times the rent to say this is the liability. So even Cap Like You to do those adjustments, they say like, oh, I'll just do 8 times rent. Like I don't think that's like reflecting the actual liability. The flip side is Fitch Ratings went against the grain and said, we're going to ignore the lease standards. We're going to reverse everything in IFRS. And we're going to go back to the old way, and we don't think these are debt-like obligations. So I was actually shocked to see that in their methodology. But just to show, even like major rating agencies are diverging in their approach of operating leases. So I just thought it was interesting in that respect of what you guys both said. Sandy, any comments from an industry perspective before we go to the next polling question?
I have some comments, but they're sort of a transition to the next question in the sense of the interesting part about the lease adoption is the industries most impacted by lease adoption are also the industries most impacted by COVID-19, being airlines, retail, and telecommunications. Some good, some bad, right? That we have actually, as an organization, had a big debate on the leasing standard in that we did not like the measurement. We wanted the liabilities and the asset recognized. We disagreed with the measurement. We disagreed that it wasn't updated, and we disagreed that certain variable lease payments were not included, because I showed some examples in the paper that I wrote about the vast majority of lease payments for the airlines were not included in the lease liability. If you look at the disclosures, because they early adopted. Now, maybe that turned out to be a good thing because those variable lease payments went down. But I think that the adoption and the resulting impact of COVID-19 has some really interesting research questions within it as it relates to what these asset and liabilities economically represent on the balance sheet. We can talk about that in a moment, but I wanted to say that it is ironic, maybe sadly ironic, that we waited so long to get these on the balance sheet, and then the industries most impacted by COVID have other underlying economic issues that need to be incorporated in the valuation. So we'll get on to COVID-19.
Okay.
I don't need to do that. But
we have a question. Yeah, precisely. Then we'll talk about the the impact of COVID-19 on leases. So let's just move on to the next polling question, which is we want to learn about what you are doing. So what is the primary purpose of the valuations you perform or review? So here's the polling question on the screen. Is it financial reporting, tax, litigation, fairness and solvency opinions, or other not applicable? So it doesn't mean that you don't do all of these, but it's what is the primary, what do you spend most time on doing valuations? That would be very helpful for us to know. And the results are, okay, 2/3 do financial reporting. Okay, that's very informative. So a lot of the stuff we've been discussing is definitely pertinent, hopefully, to what you're doing. Okay, so before jumping to the COVID-19, let's take a little bit of a focus on the valuation of businesses. And the reason, and we actually have been getting a lot of questions on the chat box precisely during this topic, and we hope that we address it with this discussion. And maybe we will, when each of one of you can talk about both if you're doing a market approach, in other words, if you're computing trading multiples from listed or publicly traded companies, what are what you're seeing there between IFRS 16 and 842 in terms of comparability. Compared to, for example, the DCF, like the discounted cash flow approach, how are people incorporating, operating leases, and what are some of the considerations when doing that, when incorporating that in a DCF type valuation? So, Steve, do you want to start with that?
Yeah, sure. Carly, you want me to talk about multiples and DCF, or do those separately?
Whichever you want. I think I'm putting, in interest of time, I'm putting like the two questions together of saying, what would you do,
Sure.
For multiples versus, like, for example, if an analyst is showing, some analysts will show a DCF, right, in their own analyst reports. And, if we're seeing any issues that affect comparability in terms of the multiples versus the DCF analysis.
Okay, so with multiples, I think if you're using PE ratios and equity multiples, not a great deal has changed. There's a slightly different pattern of expense with the front loading in IFRS 16, but that's only really an issue for growth companies. So for most cases, PE is fine. The difficult one is enterprise value multiples. And the key thing is to be consistent. So you've either got to treat leasing entirely as an operating item or entirely as financing. You've got to make sure your numerator and denominator are on a consistent basis. So I think for IFRS reporters, it's pretty easy because you've got the liability, you've got the interest expense in profit and loss. Operating profit is pre-interest, so your EV to EBIT, EV to EBITDA multiples all fall out fine, including the lease liability and enterprise value. For US GAAP reporters, it's more of a problem because you've got this liability on the balance sheet, which many regard as debt. I know some sort of think of it as not debt, but then you've got an income statement which is inconsistent with the way in which the balance sheet is presented because you have an asset and a liability and you have no depreciation and no interest, which to me doesn't make a great deal of sense. So you've got to make an adjustment. Either you've got to remember not to include the lease liability in EV, and then you're fine, or you've got to, if you do include it in EV, you've got to make sure you adjust the income statement. So if you're doing EBITDA multiples, it's not too much of a problem. You just eliminate the rent. But personally, I don't think EBITDA multiples are particularly useful. So if you want to do EBIT or NOPAT or something like that, you've got to then split the rent between the depreciation and the interest and effectively recreate what the P&L would look like on an IFRS basis. So that's essentially what you need to do. Some analysts have complained to me that IFRS 16 has introduced a comparability problem because of the different length of leases. So whether you have short-term leases, long-term leases, has an impact on valuation multiples and return on capital and the like, and introduces a lack of comparability. But this is not a new issue. I mean, I agree with them, but it's not a new issue because whether you owned assets or whether you had finance leases, or whether you had operating leases previously, your multiples and ratios differed anyway. And you always did need to do something about that. It's just that often people didn't bother because finance leases weren't particularly material, and because with operating leases, they were all off balance sheet, so you got some sort of comparability from that. But now that they're on balance sheet and with different lengths of leases producing different liabilities, it's more of an issue. So I think that investors need to pay particular attention to that. I mean, there's a technique to deal with it, which I call opco-propco analysis, where you analyze a company and you separate out the asset ownership from the operating business, and you create multiples for the operating business, which are then much more comparable. So I think that's something that people particularly need to look out for, where the degree of asset ownership is very different. So going on to your second part of discounted cash flow, well, it's essentially the same. You've got to be consistent. So you can either regard leases as operating items, in which case you don't include leases in your EV to equity bridge, you don't include the cost of leasing in WACC, and you include the rent expense as an operating outflow in NOPAT or free cash flow. So that's consistent, that's fine, and that's essentially what people tended to do before in respect of operating leases. The alternative is to treat it as all financing. So in that case, you do include leasing as a component of the equity to enterprise bridge, so the liability is deducted. You do include the cost of leasing as part of WACC, and you need to make sure that your free cash flow calculation includes only operating cash flows and not any part of the financing cash flow. And this is where the particular challenge arises, because of the non-cash nature of signing new leases. And this is a common problem in DCF analysis. It's the same issue that you have with share-based payments, for example. So when a new lease is signed, the liability goes up and the asset goes up, but there's no cash flow. But in reality, there's two offsetting flows. There's an inflow because you've obtained finance, and there's an outflow because you've purchased a right of use asset. And the trick is to think of leasing in that way, because the inflow from financing is a financing item and is not part of your enterprise DCF. And the outflow in terms of buying an asset is an operating outflow and therefore is part of your enterprise DCF. So the odd thing about DCF analysis is that to get it right, you've got to include more than just literal cash flows. And that's where I know people have struggled with this. And I noticed one of the questions in the Q&A box was, what do you do with the leases in the sort of the terminal value calculation? Well, you do need to recognize this effective capital expenditure, the ongoing CapEx, if you like, in respect of leases for your free cash flow forecasts, and then particularly in the terminal values. And I know different advisors have given different approaches to this, but the effective cash flow methodology is the one that I think is the most easy to use in the context of an enterprise DCF calculation.
And that's an excellent point, Steve. I mean, this was, I think, very, educational for the entire audience. I think this was wonderful, but that's exactly like that assumption, the same thing as you mentioned with stock-based compensation, whether you assume that this is the current level will continue into perpetuity, or do you need to make some sort of adjustment, for example, to take into consideration that this is the continued level of financing, quotes, via operating leases. And what I've seen in US GAAP is just people prefer to not deal with a headache and just continue to do the DCF, particularly because you would have to recast management's forecast. Whereas I'm seeing in IFRS, people saying, well, management is already, because they started their financial system now is based on separating out depreciation and interest expense. they're forecasting that way. And so I'm going to take those projections that already make that separation. But I think very critical what you mentioned is like, how do you adjust the WACC to make sure that it's apples to apples, which I think a lot of people forget about that component. So that's very interesting. Brian, do you want to give another perspective on this discussion?
Well, just very quickly, because I did agree with everything that Steve said, and I think your phrase "apples with apples" kind of gets to the heart of it, doesn't it? And IFRS is kind of an apples for apples kind of model. So you start off with one version of apples for apples. US GAAP isn't really, and is therefore kind of more difficult to deal with in that sense. Perhaps just two cautions, which I think Steve was hinting at, and this is a point that somebody made in the chat. So IFRS isn't completely apples for apples if you have a variable lease payment. So a variable lease payment is not treated as a financing flow. It's treated as an expense when it's incurred, probably as an operating cash flow. One of the things we're seeing through COVID is people wanting to convert fixed lease payments to variable. So it was always a glitch that you had to deal with, and maybe it's becoming a more important thing you have to deal with. The other point, again, which Steve was kind of hinting at, is that if you're looking at the long term, you do have to remember that both of the accounting models under IFRS and US GAAP are contract based. So they are just pulling into the balance sheet the actual lease contracts that are in place on the reporting date using some very specific measurement rules. They are in no way telling you about the long-term operational gearing that the business needs to keep going. So apples with apples, but do watch out for variable lease payments. Do watch out for the fact that you're very focused on the in-place contracts.
Excellent advice. CK or Sandy, does any one of you want to comment on this question before we move to the COVID?
Not me. I'm in raging agreement with what Stephen said.
Okay.
Yeah. Carla, I think one point I want to so-called point out is regarding the lease abstract, whether the occupiers or the lessee, they have properly record what they have got in their leases, because this sometimes could be a very difficult exercise. When we look at cash flow, for example, if your lease have some sort of, not just, as Brian mentioned a few times about the variable rent, but whereas, your lease would have the sort of rent review clauses to adjust to market or mark to market, how that would change, in the course of the lease, that would cause a lot of issues. What would you make, for the assumption of the cash flow? And how the operation or the occupation of the lease would take place if you have certain subletting right, and that you may have some sort of early termination costs. All of these would need a lot of assumptions in your cash flow model. Yeah, thank you.
Okay, and I think this is a good time for a polling question, and I sort of skipped one of the polling questions, so I'm going to ask Richard to do both polling questions 4 and 5 back to back. So the first one would be to understand what is the primary financial reporting framework that you report or perform valuations under. So is it IFRS, US GAAP, another like local statutory GAAP, so for example, UK GAAP or something like that, or other not applicable? Okay, we have 2/3 doing IFRS. Okay, that's interesting. So I would say that even if you're doing IFRS and the apples to apples comparison is easier, still understanding that a lot of the valuations and companies, particularly if you deal with global companies, either report in one or the other. So you still need to understand the comparability issues. The next polling question is about whether the introduction of IFRS 16 or topic ASC 842 caused you to revise the valuation of companies or of specific assets. So this comes back to the discussion we just had. What are you doing? Did you change your approach? So that often, did this made you revise your assumptions? Sometimes, so just in some cases, you rarely make any adjustments or you never make any adjustments. Okay, so the preponderance seems to be sometimes, and I'm going to guess that it probably depends on the industry and whether operating leases are material to the industry evaluation. That's going to be my guess, but I'm speculating, of course. So we're now going to move to a different topic, which is more focused on fair value measurements, financial reporting considerations. But the one thing we wanted to get started, and Sandy is going to start us with that, is to see what the impact of COVID-19 had in the implementation of the new lease standards, because it came right at when many companies were public companies anyway, were adopting the standards, and here you get hit with COVID. So how does this impact the analysis and the valuation? So I was just going to start with you, Sandy, on what you have been looking at since COVID.
Well, as I said before, I mean, the biggest industries impacted by leases are also some of the biggest industries impacted by COVID-19. And I think I don't think it's yet time to do a deep dive into, or the information is just now becoming available as to what the impact is on the actual lease liabilities and the underlying leases, right? So I had said before that we didn't really care for the measurement of the leases. And I think CK made a comment like present valuing the leases would make it really messy, et cetera, but we sort of wanted that, at least not, if not a disclosure, because, and particularly now in the context of, I can recall a roundtable on leases, and somebody made a comment about the difference between remeasuring the lease liability and keeping it constant. And one of the participants, who actually is affiliated with CFA Institute, said, companies like Toys R Us, at least once in its life before it died, I don't think it's resurrected itself again, traded based on the value of its leases, the underlying value of its leases, and that they were so below market. Now, the opposite, I think, is probably true right now, right? So I was asked a question about the impact of COVID-19 on leases last fall, and I looked up what the impairment was of, and maybe I'm jumping ahead a little bit to one of your other questions, but what was the impact? Did many right of use assets, were they impaired? And only about, I think it's for all US companies, I looked on CalcBench last night, it's $4 billion in 2020. And one company is 10% of that, which was the Gaap, took a almost $400 million charge. And then 2 airlines took big charges. I think 11 or 12 companies were half of the number, right? And they were retail, telecom, and airlines, like we would have expected. But I think that there is a good research study there in what happened to the for airlines, what happened to variable lease payments. We haven't had time to undertake this. So it's my musings based on what I saw when I was doing it. What happened to the variable lease payments? What happened to the underlying assets? What happened to the value of the leases? And what does it economically mean? And one of the things that happened during the COVID-19 last spring is that the FASB and ISB were asked the question, look, there's all these lease modifications going on. Can we get some relief from how we account for these? Because what the standards require is that when you modify the lease, it's a significant modification, I won't go into all of that, but you have to recalculate the lease liability and the right of use asset. I'm being way oversimplified here, right? But what the FASB said is we don't have to consult on that. We're going to give you that opportunity, right? And the ISB consulted and they allowed that, but but when you're allowed to do it or how long you're allowed to consider that as a non-modifying event are different for both. And what was most important to us in our comment to the ISB is that if you don't modify the balance sheet, what are we going to see happen? Particularly if you had a rent concession where you had free rent or you had a deferment. If you have a deferment of rent, the liability is changing. You probably won't see it much, even if you did modify because the interest rate isn't changing, but the cash flows, we'd like to know not just what the cash flows were last period and what the cash flows this period, but what the change in cash flows are. So we know how that cash flow pattern of the liability is actually changing. And did you add it to the end? Did you spread it out? What's the consequence of that? And there was also a difference when we went to the FASB and looking what the FASB was doing and asked, and I don't think it was answered, if memory serves me correctly, from the ISB, is that when you have a rent concession, when do I take the gain? Do I take the gain when I get the concession for all the period I don't have to pay? Do I take the gain when it comes due? And there was no consistent answer for that. Actually, I think KPMG, and maybe it was KPMG in the US, did a great publication on all the different options you have in not modifying and what that actually means. And it's super complicated. I guess my overall point is that the COVID-19 impact on leases, if you have significant leases and there's a mention of a change, if I was an analyst or a valuer, I'd be asking, what did that change look like? And what did it look like on the actual cash flow pattern? Because I don't think you're going to see it very well in the financial statements. And how long does it go? How long does it go on? So that's, I think that and the real underlying economics. I mean, the point of our asking for leases to be on the balance sheet is that they were really liabilities, and that you're really, you're buying the right to use something. But these are companies that have been affected by, the right to use that retail space when no one's coming in it and you're getting rid of it. You need to impair it. What does that economically all mean? I think that is, for me, one of the biggest impacts.
And Sandy, actually, that's an excellent point, because the one benefit that I thought was coming through with the new operating leases is, from a valuation standpoint, it made it easier to identify not the fair value, but something closer to fair value of the lease obligations for me to get to an equity bridge. So I had thought, like, great, this is a great improvement. And now with COVID-19, because modifications are not being required to be like restated, if you will, which would be like our equivalent. It's not fair value, but it's closer to. We lost that ability as analysts and as valuation professionals. So now we don't know whether that liability that is on the books is really reflective of close to fair value, because they have this option to look. And I understand why they needed that relief in some ways, because there were so many modifications, so many things going on in financial reporting. But just strictly, if I'm a little bit selfish and think just strictly from a valuation standpoint, we lost some of that comparability that I was sort of trusting. And it's, with interest-bearing debt is, and just let me just point one thing. With interest-bearing debt, we actually have the extra ability, because you already have a fair value requirement, both in the IFRS and US GAAP, to say, you are on the balance sheet, this is book value, but in the fair value disclosure footnote, we tell you what the fair value of the debt is at the reporting period. So you do have that bridge for interest-bearing debt, but you lost it for leases. Anyway, so go ahead, Sandy. I'm sorry, I just wanted to make that.
It's ironic that we wanted that remeasurement, and we got COVID, which might tell us that remeasurement would be really interesting. Even if we don't adjust for it or whatever, it's telling you something about what economically is going into the business and what staying or going or not having gate rentals because you're not at the gate. There's a lot of interesting underlying economic issues there.
Yep. And so just to give us a little bit of a different perspective, and I know, so we're going to go to Brian, and then I'll be curious to hear about CK, because he talked when we were having our prep calls about what he's seeing going on in, say, Hong Kong with the COVID-19 and the things that he saw happening there. But Brian, do you want to give us a little perspective on the COVID-19?
Yeah, so maybe I'll just try and round off this discussion about rent concessions and what happened at the ISB and the FASB, because clearly one of the huge benefits for the standards is it brings these leases on balance sheet and it tells you that there's an issue in these current market conditions. The standards as published then have really detailed guidance on what you do when you change the terms and conditions of a lease. And that's one of the great benefits of the standards, actually. And as you're saying, typically, if you change a lease, but it's the same lease of the same asset, then you would update the discount rate. So you would get much, much closer to a present valuation if you followed the standards as published. And that would have been really interesting information. That's what you're saying. That's what you're both saying. You would have loved that information, wouldn't you? But the practical expedients under US Gaap, under Ifrs, they're a little bit different. But they basically allow you not to change the discount rate when you change the lease due to COVID. And the question is, what was that the right thing to do? The CFA kind of wrote in, there were a couple of dissenting opinions from board members, and I guess for me, I was more accepting of providing a bit of relief. To be honest, I was thinking, we've got these companies, they're really struggling. Everyone's preparing the financial report, sitting at their kitchen table, and the auditors sitting at their kitchen table. So let's be practical. Let's just help these people get the audited information into the marketplace on a timely basis. I suppose the other thing I was thinking about was, not updating the discount rate. You lose some information, you lose some comparability, but this is a discount rate play, isn't it? And I think we have to be realistic about whether or not the discount rates that people are using anyway are in fact comparable. A lot of discount rates are just the discount rates that people settled on when they transitioned to the new standard. There was a lot of optionality in those transition requirements, and even if people had to update them, that wouldn't have been a comprehensive updating, would it? It would have just been an updating for the leases that had in fact been modified. So I might have had 10,000, I'm a big retailer, I've got 10,000 leases, I agree 1,000 rent concessions, and that means for 1,000 of my leases, I've got an up-to-date discount rate, and for 9,000, I've got whatever discount rate I guessed when I transitioned at the beginning of 2019. So I understand your kind of frustration about not getting this up-to-date information, but I understand why the boards offered that relief. For me, the question is, how do we close this down? The ISB's practical relief, it's time limited, it expires pretty much this time next year. And the question is, how do we wean people off this practical expedient and get them back to using the guidance that was in the standards as published, which, as you say, would be driving this much more current information based on current discount rates?
Can I add something here? Because I sound very cold-hearted, and I guess Carl is with me then. I think what we were saying is that we didn't mind a modification. We didn't actually think the discount rate would make much difference given, interest rates were nothing at the time, right? What we said was, just give us the change in cash flow. That's all we want, right? Because does it affect our model? But more interestingly, it's an economic question for a conversation with the company about what's actually going on. That's what we really wanted. And we couldn't even get that. So I guess I totally get that doing that calculation and adjusting it and whatever. We were interested in the cash flow. Just tell us what changed. Did you not have to pay something? or did you move it all to the end, is what we were trying to get from that, so that as investors, we could have the conversation, and as valuers, because they're doing the same thing, we could have the conversation we wanted to have. That's what we were looking for.
So I'm happy to agree with you, I have to say, on disclosure. So there is a disclosure requirement. It's quite a limited disclosure requirement, isn't it? And it's, I'm hearing from everybody that it doesn't tell you what you'd really like to know about what's happening in the cash flow. But cash flow is really important. So in London, in the FT, I read a lot about whether people are really paying their rent, and I read these horrifying statistics that, you know, the big property companies are collecting in the UK. They're collecting 15, 20, 25% of the rent on the rent due date. I mean, my goodness, you know, and that's, I'm not saying that then people aren't paying because they've got a rent concession. They're just not paying, which I guess, CK, is my prompt to you. You know, what on earth's happening when people are just not paying their rent?
Right, because this actually impacts lessors, not just lessees. So CK, what do you think?
I mean, we come back to the real world, not just looking at the future cash flow. I mean, because we enter into the arena of the landlord and tenant law. How business, would react, to such a difficult situation. When you talk about the London market, that recall me, the Asian financial crisis. Some retailers just present their coupons to the landlords. So ask the landlord to help them to sell the coupon so that they have the business to come in so that they can pay the salary and the rents. So what I see right now, the COVID issue have actually accelerated a lot of the changes within the real estate industry. A lot of the occupational mode, of different type of, business would change. We have mentioned about, the retail market, the airline, but I would like to highlight, for example, the hotel industry, the food and beverage have also been really, adversely affected. What you mentioned about, retailers have paid much lesser rent, and that some of them have actually walked out from the premises. They just turn back the keys. And that, some of them have negotiated for, rental recession. Some of the landlords want to keep the retailers or the operators there to keep the shopping center or the building, to have a feeling that it is still full. So these are the situations that we have been seeing in a difficult situation, how the landlord and the tenants, they will react to the reality. And that actually I've seen in Hong Kong, for example, some of the retail leases have become much shorter these days, just a month or a few months, because they don't know what the business will look like. And that, I would see that, the retail rents, for example, or the F&B would be dictated by the sales revenue and percentage of that. So in the future, more of the business will switch, as Brian just mentioned, about to the variable rents, or just to rely on the turnover rent instead of have a high fixed rent to start with. So I think this market is still yet, to see a lot of changes, how the operating leases, would be structured in the future to cater for the flexibility that the business would require.
Yeah. One thing I would say to Brian is that in the U.S., one company actually was fined by the U.S. Securities and Exchange Commission because they knew they were going to stop paying their rent, but they didn't tell the market that until after they got some additional financing. And so they paid a fine. The fine was actually considered way too nominal. It was definitely worth what they did, in the sense of if they had told people that, they probably wouldn't have gotten the financing that they got. But they didn't make a timely disclosure of the fact that they've chosen not to pay. So that was our concern was driven based on, we want to know when you know what you know and what's the actual impact of it on cash flows. This accounting stuff, not so important.
That's interesting. Well, I think, this has been a fascinating discussion, and I think we could be here and talking way more. I'm going to ask Richard to go and have the next two polling questions. So it would be the two final polling questions. And we may skip a bit of the discussion that I still wanted, but let's go here. So in what areas did the onset of the COVID-19 pandemic create additional challenges when dealing with 842 and IFRS 16? And here you can select all that apply. So was it in impairment of right of use assets, for example, under IAS 36 and Topic 360? Was it on determining the incremental borrowing rate at current market conditions? I'm going to guess that people weren't doing that. They were just using the relief. Incorporating lease concessions like rent reduction, payment extensions, etc. There were no additional challenges from your perspective. The issues were just similar to what you had encountered prior to the pandemic, or are they not applicable? So let's go and see like and okay, the biggest challenges appear to be on the impairment of right of use assets. That's interesting. So let's go to the next polling question, which is, what are the main benefits of introducing the IFRS 16 or 842 from a valuation perspective? So, and again, you can include all that apply. So having the lease liability on balance sheet, more data in the financial statements, greater comparability between companies, or you don't think there are any benefits. So let's see what the answers are for that. And okay, so the biggest benefit, I guess, is having the lease liability on the balance sheet. Okay. So we were supposed to discuss another, financial reporting question of like how, what the new standards had impacted in goodwill impairment and impairment of right of use assets. And I don't think we're going to have time for that. What I'm going to ask is for each panelist to give us some closing thoughts about the lease standards so that we sort of finish more or less on time. So Sandy, do you want to give us your closing thoughts on this topic?
I guess, in preparation for this, and going back to what I wrote in 2019, I certainly think that the paper and the comparisons that I did was useful. I missed sort of the ratio on enterprise value, which I think is important, and recognizing that some of these heuristics, other than these traditional ratios that I was thinking of, were how they change. I think that I personally think that IFRS has achieved a better answer. I think that people in the US who aren't acknowledging that this has changed aren't necessarily doing it justice. I think they should, and I think that there will be really some interesting valuation and studies to be provided by having the adoption and then a big impact to leases of the pandemic. And I hope people aren't modifying their leases for the next 2 years. That's what I mean.
Yeah. Steve, do you want to give us your closing thoughts?
Well, I was pleased to hear Sandy say that the IFRS 16 gives a better answer because, I guess I would say that, wouldn't I? But yes, I do agree. I don't think ASC 842 is really so good because of the confusion it introduces between balance sheet and income statement. I mean, mind you, I don't think IFRS 16 is perfect by any means. There is one aspect that I think valuers should look out for in particular, and that's for inflation-linked leases, where I think the liability is understated. So that's some particular thing to look out for. Also, reiterate the need to be consistent when you're doing multiples and DCF. I think that's really important. I think IFRS 16 is great and helps, but it can also lead to some really bad errors if you do it incorrectly. And do think about that OpCo-PropCo analysis that I mentioned, where you've got different exposures to property or other large ticket leases. I think that's important as well. Okay, thanks.
And Steve, if I can plug your Footnote Analyst website, you actually have an article on that issue, right? The OpCo/PropCo?
Yeah, I do. I just, before we finish, Carla, the questions that have been coming in, there's one or two aimed at me, and some of them are, many of them are very interesting. Will we get an opportunity to answer these offline, perhaps?
Yeah, we will coordinate with Richard to make sure that we collect all the answers.
Yeah, I mean, people are taking the trouble to send in these, and it would be good to provide some answers where we can.
Some feedback. Yeah. Absolutely, yes. CK, any closing thoughts?
Thank you, Carla. I think, whenever there are, new regulations or changes to the existing regulation or requirements, then we will see that the market, in particular for me, the property market will react to the same. And that, for us as the professional in the real estate market, we need to follow what has been happening and then observe, the trends, that will take us further, into the future. And that we add, accordingly to provide advice, to our clients, how to deal with such changes to achieve the best result of their business. Yeah. Thank you.
Excellent. Brian?
Just very quickly, I think these standards have had an absolute baptism of fire due to the market conditions in which we've been working with them. And I think they've stood up remarkably well. The rent, we've talked about rent concessions, differences between US GAAP and IFRS, and we've said, oh, couldn't they be different? Couldn't they be different? But honestly, I would not have wanted to have been an auditor in the last 2 years with all this stuff off balance sheet. It would have grossly, I think, misrepresented the economic position, and we would have had countless companies struggling to pay payments for off-balance sheet liabilities. And honestly, that would have been completely and utterly unsatisfactory. We all wish the standards had been a little bit different, or maybe a lot different, but they're a big step forward, and I hope they get fully integrated into valuation practice as well.
It's great. And I'm going to give my final closing thoughts, just leveraging off of what you just said, Brian, which is I'm in full agreement. So even before the adoption of the new standards, I always had like a calculation of present value of which was imperfect, but the remaining lease payments to try to come up with a quasi capitalized amount. And people rarely did it. And yet, we made that option available because people said nobody cares, even though it is a true obligation, right? And so I do believe that this was a big step forward. I am also in agreement with the fact that, unfortunately, US GAAP created problems from a valuation standpoint by having that discrepancy between income statement and balance sheet. And so that's creating some of these headaches currently. But in general, I do think this was a very positive movement by financial reporting to actually acknowledge that these are obligations that should be recognized and disclosed on the balance sheet. So with that, I want to thank you, my fellow panelists. I think this was a awesome, not these superlatives, but I just do think this was an awesome discussion. And I really, it's been a pleasure and honor to be on the same panel with you. Thanks so much.
Thank you, Carla, and thank you to all the panelists. Just before everybody dials off, just a couple of really brief things. A podcast of today's webinar will be made available later this month, and you will receive a link for that email. Steve mentioned that there have been countless excellent questions that have come in, and yes, of course, we will take those away and look to provide responses where we can, and look at how we might kind of reconvene sessions like this going forward on similar topics. It's no surprise that we went into overtime today, but we probably could have gone on for another hour or so. Please, if you could take 2 minutes at the end just to provide some feedback in our post-webinar survey, which will be on your screen shortly. And if you want to claim CPE credits, then you need to indicate on the survey form that you would like to receive those. Again, thank you to the panel, and thank you to Duff & Phelps, a Kroll Business, for sponsoring this webinar, and to you for joining us today. Thank you.